Yeah, well, longshoremen getting a 70% increase in wages, those costs will be passed on to the shippers. So you're going to see some margin compression probably next year start getting priced into the earnings expectation for the shipping companies. But we also shouldn't ignore the fact that geopolitical risks are rising. We've already got disruption to the Red Sea shipping lanes. Potential action towards Iran could also further destabilise the region, which means that shippers have to divert further activity away from those traditional lanes and take on longer routes to deliver their goods to the end customers.
Indeed, indeed. And so you think that this is just a knee-jerk reaction right now that we're seeing in these stocks in this sector, or, because of the geopolitical risk premium and the pass-through of rising wages on the margins, or this is something that would structurally impact the sector for, let's say, a couple of quarters?
Well, the broader question is, which asset classes are discounting an acceptable amount of risk premium from a geopolitical perspective? The only asset class that's really been doing that is gold. If you look at crude oil, if you look at equities, there's very much a benign sense that the world hasn't changed very much. But we are potentially on the cusp of a new era where traditional supply chains, trading activity being unspoilt by tensions and flashpoints is changing. It's no longer going to be the base case. And as a result, certain asset classes, whether it's shipping companies that are very sensitive to global trade activity or oil or other commodities, factoring in a structurally high degree of uncertainty in geopolitical tensions is key.
Yeah, a lot of the headlines this morning have been putting the spike in oil down to some of Biden's comments overnight, as far as just how symbolic a potential retaliation could be. But, talk us through why you believe the oil markets, in that sense, as you've been saying, have been so pragmatic in their approach.
I think it's that the fundamentals have been outweighing some of these more sentiment factors. So our fundamental view at Manulife is that oil prices look like they're going to, so oil markets will be somewhat oversupplied next year. And that's as a result of the gradual unwind of the production cut agreement of OPEC+. In addition to the fact that US onshore producers are really running at full pelt, and so production will be elevated again next year. And at the same time, there are some signs that demand is softening at the margin, particularly in China, but other large growth areas as well. So as a result, the fundamental balance for oil doesn't look too promising on a 12-month horizon, and that's probably dominated the debate for oil traders recent times. However, with the Middle East tensions, with Biden effectively endorsing the reality that behind closed doors Israel and US are discussing what kind of retaliation might be feasible, potentially the oil infrastructure for Iran, that then starts to come to the forefront, and fundamentals tend to get pushed to the side temporarily.